Good afternoon, good morning, and good evening to everyone that's joining us today, wherever you're dialing in from. My name is James Ridley. I'm the Managing Director for the APAC region for our Atlas Wealth arm. I'm joined today with my co-host, my colleague, Ben Turner, Managing Director for Atlas Tax, based down in Adelaide. We won't hold that against him. There is a lot to cover today. The 2026-2027 federal budget, and more importantly, what it actually means for Australian expats. I do have clients joining today which aren't Australian expats anymore, and we'll be putting out plenty of good material for those that obviously aren't living overseas anymore. But this is probably one of the most significant budgets we've seen in probably the last 15, 20 years when it comes to tax reform. You've probably seen a fair bit in the media, especially over the last couple of weeks leading into the budget. There's a fair bit of noise, commentary around the budgets. Our goal today is just to cut through and focus on what is real, what is changing, and how it may impact you. We'll keep this practical and relevant. Not everything announced in the federal budget matters to expats, so we'll focus on the areas that we believe do. So why don't we kick into it? Bit of a disclaimer, everything we are covering today should be treated as general in nature, is designed to inform and educate rather than provide any sort of personal advice. Everyone's situation is different, particularly as expats where tax residency, jurisdiction and structuring can vary significantly. So before acting on anything discussed today and anything here, you should definitely seek advice that's tailored to your own circumstances, whether it's from a tax advisor, financial planner or legal professional. For those that are new to us, a quick introduction. The Atlas Wealth Group, we specialise in working with Australian expats. We provide financial advice, tax, mortgage and asset management services in an integrated way. We're regulated both in Australia through ASIC, the ATO, and over in the UAE, where our other office is based through the DFSA. It's relatively unique, especially for an Australian firm operating in that region. We currently work with clients in more than 50 countries. We've stopped counting, and we manage over $500 million in assets. Again, we've stopped counting on that one as well. Importantly, all of our advisors and specialists are degree qualified with further credentials. That is something we place a strong emphasis on, particularly in a market where standards can vary significantly across those different advice lines. In terms of our agenda today, we'll keep things structured and straightforward. We'll start with a high-level understanding and overview of the federal budget, move into areas which then apply and are a bit more significant for expats. I'll cover the budget at a glance. I'll discuss Australian shares, superannuation, and a little bit on property, and then I'll tow Ben in to finish off on property, Australian trust, I should say, and Q&A. Q&A we often find on these sessions is the most valuable part and can run long. We did do a session last night for the Europe, Middle East and Africa's region, so I've called Ben up to get him backing up again. A lot of good questions. Some questions are hard to answer based on personal situations, so we will do our best, but it might be a case where a call is needed thereafter. If you do have questions, please submit them in the question box and then we'll get to them at the end. If there's some questions I can address in the background or Ben can by typing in response to them, we'll do so as best as we can. Rightio, with that in mind, let's jump straight into the budget. I'll start with a quick overview of the key announcements before we get a bit more details and material changes for Australian expats. So at a high level, there are three key points certainly worth noting on. First, the legislated tax cuts. The marginal tax rate for the lower bracket reduces from 16% to 15% from 1 July 2026 and then down to 14% from 1 July. Not a new announcement as part of the budget. It's mainly been, I suppose, just coming into effect right now, but it was something that was briefly mentioned. Second, the WATO, government loves a acronym, the Working Australia's tax offset. This is a very small or relatively small offset. It starts from the 2027-2028 income year. It's applied automatically through the tax return system. The third is the $1,000 instant tax deduction from 1 July 2026. Australian tax residents, so not necessarily applying to non-residents, will be able to claim $1,000 of work-related expenses without itemising or substantiation, from what I understand, but I'll let Ben talk about that one if it comes up. Importantly for this audience, these measures are targeted at Australian tax residents, not non-residents. So I'm just doing a quick overview and then we'll get a bit more granular. Where the real focus should be for today's session is certainly going to be around capital gains tax, property, and those structuring changes. Let's move into it and discuss shares. So capital gains tax, um, I think when we were looking at a lot of the key announcements before the budget, the main focus was on property uh, and obviously improving housing affordability, housing supply. But the changes have come out and it is just applying now to all capital gains tax assets, all investment assets. So it includes shares, exchange traded funds, managed funds, and similar investment styles. From 1 July 2027, the 50% discount is replaced with the cost-based indexation model alongside a minimum 30% tax on gains going forward. Any growth from 1 July 2027 is calculated under the current rules, including the 50% discount. So up to 1 July, and then it obviously resets. Any growth after that date is calculated under the new indexation model. So a simple way to think about it would be if you hold an asset on 1 July 2027, it's effectively treated as if you have reset the cost base at that point for the new capital gains tax calculations and the old ones are grandfathered. The minimum 30% tax is a question I'm getting a lot on, but yes, any gains after 1 July 2027, you will be paying a minimum of 30% tax on, regardless of the model. We'll go into this a little bit more shortly. The good news for expats is this does not actually have a material change on the position around shares. So when you are a non-resident of Australia, generally capital gains tax does not apply to shares, ETFs, and similar assets. That remains unchanged under the current proposal with this budget. There is one exception to this. That's if you leave Australia and you choose not to crystallize your gains at that point when you're leaving and becoming a non-resident, you're not deemed disposing on those assets and paying essentially an exit tax on the capital gains, then these old rules will and could apply to you. We do need to see the draft legislation, but I'll let Ben talk about that because there is potentially a sleeper in there which could benefit expats as well. Australian superannuation. I'm just going to briefly touch on this. For most part, the core settings of Australian super remain unchanged. The preservation age, that my microphone has changed. I'll just make sure everyone can still hear me. Ben, give me the nod. Yep, all good. Super remains materially unchanged. The overall tax treatment, nothing was really commented on within this budget, which is good to see. There are some key updates though, two key updates I'll just touch on briefly. First, the additional 15% tax on balances over 3 million, that is scheduled to commence from 1 July 2026, and the additional layer of balances over 10 million with the additional 10%. The second, which was surprising, there are some changes to pension supplements. So for Australians that are living overseas, the eligibility is extended for a longer period when temporarily abroad. So it was previously 6 weeks, but now that supplement can be received for up to 12 weeks if we are overseas. So that was actually a bit of a surprise. Division 296, that's obviously this additional 15% tax that we can see applying from 1 July. Just want to make a note on that one that was announced pre-budget back in 2023. It went through a lot of consultation, structural redesign, and then it was finally legislated as of March this year to apply from 1 July 2026. So that took a couple of years to actually get through the system and be legislated. And that's just a really good example of significant tax reform and sometimes the delay it can get to being legislated, because that was meant to get pushed through pretty quickly. There's a good example. The expat impact. So what this highlights more broadly is just how I think tax effective superannuation remains. I think the night after on Wednesday when I was reading through the budget papers on Tuesday, and the morning after in the wee hours of the morning, one of my most important takeaways for a lot of my clients is that super is just so much more important now. If everything gets legislated as is, then we really need to be paying attention to super and contributing to it and loading up as one of our fundamental and really important retirement assets. It will form one of the main key pillars. When you compare the 10% capital gains environment within super to the potential 30% minimum rate outside, the relative advantage becomes quite clear. For expats, it's also worth reinforcing that you'll still continue to contribute to super whilst overseas. So if you're in the United States, there's obviously potential issues with that, with contributing to super, depending on the US account's interpretation of your super fund. So I just always want to put that little warning in there. But if you're in other countries which don't have any tax treatment on super, it's sort of preserved, then contributing to super could make a lot more sense now. Because the structure of those contributions may change, but it still remains a very tax-effective tool. Finally, here on this slide, just a quick caution on self-managed super funds. So if you're living overseas, you need to be very mindful of the residency rules, particularly around central management and control and the active members test. These rules have not changed. There was nothing in the budget about this, but they remain a key risk area for any Australian expats living overseas and still running a self-managed super fund back in Australia. Moving into Australian property. So some big changes coming through on the Australian property front. A major structural rework. So from 1 July, same again, capital gains tax, the 50% CGT discount is being replaced by that cost-based indexation model, a 30% minimum tax of the net gains that accrue after that. So pre-CGT assets, and I think this one is just, this is really going to impact a lot of old farming families, but pre-1985 assets are no longer exempt for gains rising on or after 1 July 2027. So they get essentially a cost base starting from that date, and then they'll start accruing taxable capital gains if it's an investment asset. Cost-based indexation replaces the 50% discount. Your effective rate depends on how much inflation eats into the gain. So, and I'll talk about that soon, actually. I'm going to jump the gun. New residential properties get a higher discount as an incentive for housing supply. Investors in new residential property can choose either the 50% CGT discount or cost-based indexation, noting still that 30% minimum capital gains tax rate being paid on gains after 1 July 2027. When does indexation actually match the old discount? So if we just consider an example for just a normal Australian tax resident, they've invested and bought an asset worth 500,000. It was just purely an investment asset, not a main residence or anything like that. It grows to 1.5 million, they sell it, and the capital gain is just a clean $1 million. So under the current model or the old model, they would be able to apply a 50% CGT discount. So the taxable capital gain would be 500,000, and then applying a tax rate of, say, 47%, assuming they're on the top marginal tax rate, then obviously that's where the tax comes out of. The only situation in which the indexation model either matches up or becomes better is when inflation per annum is 4.7% or higher. So that's pretty high. Our long-term average is a lot lower than that, and I'll show you that very soon. So it does emphasize that the indexation model is certainly more punitive from a tax point of view. If we just look at the CPI and the range over the last 40, 50 years, we typically float between, I would say, your 1.8 up to 4%. So we can see from that, and we can take away from that, that yes, we are certainly paying a lot more tax. We're in a period of higher inflation right now due to some obvious reasons, the Middle East as an example, but that's not going to be holding forever. So we are certainly going to be paying more tax. I'm now going to hand over the next slide to Ben Turner. Handing it over to you, mate.
Thanks, James. So look, historically, as we all probably are aware, on 8th of May 2012, the budget night back then, non-residents effectively were prevented from claiming the 50% CGT discount for periods of non-residency from that point on. So that has been, I guess, a downside, and I guess what is not 100% certain through this budget is whether or not non-residents are now opened back up to being able to use the same method of indexation that residents will be receiving. I can't see an argument as to why non-residents would be excluded. I'm hoping that is something that is in the budget, sorry, the actual legislation when it comes through. Obviously, the time value of money applies equally to a non-resident to a resident, so I can't see why they wouldn't, but also had the same argument back when they adjusted this back in 2012. So wait to see, there may be a silver lining there in relation to that, in fact that non-residents actually may be better off under this new regime than previously. So moving on to negative gearing. So negative gearing is now going to be potentially culled and limited to new builds. A lot of people are asking, well, what is classed as a new build? A new build effectively based on the budget papers, and obviously the devil's in the detail with the legislation, but our understanding is that it has to contribute to an additional housing supply. So having an old property you knock down and rebuild, whilst yes, it's a new build, it's not adding to housing supply. It really is talking about new development. So a vacant block where there was no house, you're putting a new house on it, or subdivisions and increasing the supply numbers. So negative gearing on those particular properties will continue to apply, as does those that were owned as at budget night. So that's grandfathered there. The critical thing is the signing of the contract date. So if you signed a contract prior to budget night, then you're okay. You're included as included in the grandfathered rules. So what this means is if you are looking to buy a property from overseas, then the math has changed on this. You know, normally in the past you'd accrue losses and then offset them against your taxable income when you return to work in Australia or generated other income or they became positively geared. Now, assuming you're not in this grandfathered cohort, then you only get the benefit back when the property either becomes positively geared or potentially when you sell the property. So the gains, the losses on these properties are going to be quarantined against future property-based income. But that's not necessarily all bad. And this is something that we see a bit with expats who, you know, I'll consider this example on the next slide there, James, where someone who may have been overseas for 10 years, they have been generating, you know, just say an even $10,000 worth of losses every year for that 10-year period. So they've got $100,000 in losses that they've got. If they repatriate to Australia on a $200,000 salary, but they've arrived 1st of January, so for the 6 months that they're here in the arrival year, they've earned $100,000. What the current laws require you to do is to use up all of your losses first at the first available opportunity. So in the current treatment, the $100,000 losses that you've generated get fully utilised and you don't pay any tax, but what that means is the tax on that $100,000 is $22,788 under current tax rates. So 22.7% tax saving. Now, if you consider the new treatment, assuming we're not quarantined, we're not grandfathered here, then if you're on a 200K salary, then we would only be using up, let's just assume that the property's now become positively geared by 10K each year, then because the top rate's at 190, all of that 10K is going to be coming off the top of your income and therefore at the top tax rate of 47%. So you'll use that up over a 10-year period, each at 47%. So that the benefit of those losses is going to be then 47,000, although it is delayed. Now, obviously, this is highly fact specific. If you sold the property as well, it's likely then that would just go on top of your highest marginal rate taxable income as well. So again, saving at 47% potentially as well. So there are some circumstances where the new treatment might actually benefit compared to the old, but again, highly fact specific. Moving on to trusts. Now, this was a bit of a sleeper in the budget. It wasn't a lot of talk about it prior to. There was some chatter that came out just a week or two before the budget, but it is a huge change for a lot of people with discretionary trusts. So, and the key thing there is discretionary trusts. Really what the the government's trying to clamp down on is where people will have the choice year on year to be able to stream income to tax efficient entities, generally people on low tax brackets. And what they're saying is that they're going to bring in a 30% tax as a minimum on discretionary trust income. So normally what you would find in a tax return currently is that the trust, as long as they fully distribute their income to beneficiaries, doesn't pay any tax in its own right. It just flows through to the individual tax returns or the bucket company or whatever you're using. But now this will be a 30% tax at the trust level, and then that translates to a form of credit that is lost if you don't hit that same tax rate. So if you're distributing to people who have no other income and they're the lowest tax brackets, then you lose the tax-free threshold, you lose the 15% tax rate. You're paying tax at the first on the first dollar at 30% on these sorts of things. So, and furthermore to that, distributing to, say, a bucket company, you don't get the credit flowing through either. So a bucket company will pay tax in addition to the tax that the super fund has, that the trust has paid, meaning you're effectively paying tax on tax. So they effectively have killed the bucket company structure based on the proposal, on the understanding of how this will operate. The devil will be in the detail and we need to work through it, but it's quite a huge change for people, and discretionary trust is the key here. So fixed trusts are not impacted, companies are not impacted. So, widely held trusts, complying super funds, special disability trusts, deceased estates and charitable trusts are excluded. That's because there's a fixed interest and unit component to that. So if you invest in, say, in a net wealth portfolio, there's a fixed interest entitlement. They are not impacted by this. It's those where you can pick and choose on an annual basis where the income is going through. Now, one thing we mentioned there is deceased estates. Yes, that is applicable, but testamentary trusts that are created from a will on death are also impacted. So this is a stealth death tax for those people who may have created a testamentary trust. And there's some good reasons for you to create testamentary trusts that are not for the preservation of tax benefits or anything like that. But a testamentary trust is typically established when someone doesn't want to necessarily divest all of the inheritance at once. And so sort of drip feeds it to the beneficiaries over time. Maybe they're young and they don't want to give the beneficiaries all of the income at once. And so for some very valid reasons, but what this is going to do is it's going to force a 30% tax on that. So there's going to be some strong considerations about readjusting these arrangements, and there is a 3-year window that they've said that they're going to allow tax breaks on restructuring out of these trust structures. So that there'll be a lot of activity in this market, and we will likely see people moving into companies or unit trusts. And there's also a lot of talk around the place around other funky structures that might actually work, but we'll see what the legislation says and if some of those other options may actually be curtailed by the way that the legislation is drafted. There are some, just on the next slide there, James, there are some exclusions from that, so that for non-residents, anything that's subject to non-resident withholding tax are excluded from that 30% minimum. We talked about the restructuring, that 3-year window, which applies from 1st of July 2027. And if you're returning to Australia and you're considering a trust structure, then we really want to see what the best structure may be for your circumstances, and it might not be a trust structure anymore. I'm sure everyone's got a lot of questions and all of that they're looking for us to answer. So if you do, please put them into the question box and we can go through that. You're on mute there, James.
There we go. Some of our registered listeners today have actually emailed in questions before today. So I've got actually a few that I'll read out just so we can answer them live. And if you do have any questions, just drop them in that question box, whether from yourself or anonymously, it's not a problem at all. I'll read this one out as best as I can. So the scenario is I'm selling a home in Queensland. Never been rented and grown son currently lives in it, but will be leaving in September. We lived in the apartment for 11 years before heading to Singapore in 2022. It is 95% in my wife's name and 5% in the husband's. Wife is retired. Husband's job is based in Singapore. So they're Australian expats, non-residents. Is there a rule change in the budget that affects this scenario, the timing of the sale and or the CGT will have to pay?
Mhm. Yeah, so it sounds like then it was your main residence and would have
Yep.
qualified under the main residence exemption originally. Now, critically, and then this isn't a function of this budget, but critically, you have to be a tax resident at sale to activate any main residence exemption. So selling whilst non-resident would be probably a pretty poor tax outcome. On the assumption, though, you came back to Australia and were tax resident at the time of sale, then you would be able to activate the main residence exemption and that wouldn't be changed from this budget outcome. It sounds like if it's never been rented, then it's likely you could continue to treat it as your main residence through the whole absence period that you're
Yep.
away. There are some caveats to that. If you don't, you can only have one main residence globally, so it does depend on what you've got in other countries and how they
hmm
may be treated and which one you're selecting as main residence. But
hmm
nothing in this budget that changes that position specifically, but that scenario, you'd want to make sure that you are having everything lined up to make sure you activate the main residence exemption before you sell that property.
Yep. Um, Another one here is if I own three rental properties, can I use losses from one to offset gains or positive income from another one under the new rules?
And that's something I'm waiting to see the detail on. My
Yep.
expectation is that applying it to property as a class. I'm not sure if you've got a different view on that, James. I don't think they're going to segment it into individual properties. I'd be
No.
surprised if they did, but I think they'll be applying it to properties as a class. So if
Yep.
overall you've got positively geared properties, but one of them was say negative, then they should be able to offset in this current year.
Yeah, I think just the amount of work that would need to go into the software for just only segregating it to one bucket per property. I think that would be ridiculous to be honest. So I think I'm of the mind that it'll just apply to properties as a class. I think the dates will be the key one. If you bought it obviously before budget night, the negative gearing used against the wage income that can be used. Anything after, obviously not the case. So I think that's how it'll work from an operation point of view. But yeah, we still need to see obviously the draft. In terms of usually when we get these kind of budget measures and tax reform, the first draft of legislation is usually released pretty quickly, usually between mid-May up until June, and then you get the second tranche of the draft legislation between July and September. As Ben said, they need to give the trust tax reform legislation a bit of thought. And even I think Anthony Albanese came out in the last 48 hours saying, yeah, we're going to give that one a bit more thought around the testamentary trust. And that'll probably come out later in the year. So it'd be surprised if we see that coming through any time in the coming weeks or even the next 2 months. Still got a few more that people have sent in, but I'll just jump on the live questions and then jump in between a few. Good one here from Phil Abraham. Good morning, Phil. Since the 50% CGT discount is grandfathered only up until July 1st, 2027, how exactly will the ATO determine the split if a property is sold in, say, 2030? Do we need to pay for an official independent bank valuation on June 30, 2027 to lock in that grandfathered error, or will the ATO use a prorated formula based on the dates? So good question.
Yeah, very good question. And the devil's in the detail, but might be good if I read from the HO's specific fact sheet. So if you look up the fact sheet from the budget papers, this is what it says verbatim.
Mhm.
Taxpayers can either seek a valuation of the asset as at 1st July 2027, which will include the quoted prices for assets such as shares, or use a specified apportionment formula that estimates the assets value on 1st July 2027 based on its growth rate over the asset's holding period. The ATO will provide tools to estimate the value for taxpayers. So it's interesting. Effectively, it's not an apportionment over the period, the whole period, where they're saying, this amount was pre and this amount was post. They're actually giving you a tool to estimate the assets value on 1st July 2027 based on the set parameters of formulas that they're going to release. So very interested to see what that looks like and how granular that is. And James and I was actually talking prior to the session today about how some of the issues that might come with that. If they were to release it, are they going to release it for every region in the country over what period of time? It seems like a lot of work, and there's a lot of differences between, say, normal Brisbane and regional Queensland in very specific pockets. So yeah, we'll wait and see what that looks like in practice.
Yep. Good question. Good question as well from Jenny Wilkes regarding small business CGT concessions. So are the small business CGT concessions retained, and do you think they'll stay in place long term? The government seems to have conveniently forgotten that the sale of business is usually the founder's super. Yeah, this is such a good one, and there's been a lot of memes on social media about Albanese being a co-founder, owning 47%, because obviously that's the highest tax rate in Australia. And they've really, just when you think about this budget, they've really missed the mark here. Small business owners, they are plumbers, electricians, they're your landscapers. Like these are your hardworking Australians, which are all now going to be slogged, both on the CGT, but also this minimum tax out of trust. But on the small business CGT concessions, Ben, what was your thoughts? Retained? Do you think they'll get changed or replaced anytime soon in the long term?
Look, there was no discussion on that, and I think that would be really, if the government's not going to receive a massive hit in the polls with the current budget, if they attack small business CGT concessions, they definitely will. I personally can't see them changing that. I think they are sacrosanct. Uh, I'm glad they didn't mention anything on it, to be honest. So yeah, I don't have a crystal ball, but I'm not expecting there to be any changes there.
Yep. Good question. I'll just jump to some of the other ones that were submitted just before today's webinar. I just want to give everyone an opportunity. Good question here. Can I offset my rental losses against my Australian dividend income if I'm a non-resident?
So offsetting rental losses against dividend income if you're a non-resident, chances are is no.
Yep.
So, firstly, we're assuming that you're in the grandfathered territory firstly, so that, you can actually claim it against a broad base of income and not just rental income. But secondarily, dividend income will typically be subject to withholding tax as a non-resident, and therefore it falls into a separate category of tax. So it doesn't actually get offset.
Yeah.
So there are some exceptions to that. So if there's trust income that comes through, say, managed fund, there's trust income components that are ordinary income that could be offset. So whilst that's not typically dividend income, some people might confuse that and think that that is still part of that. Yes, that can be offset on that component, but normally that's small.
Yep, that's right. Another question here from just one of our live questions. Does the grandfathering mean that the cost-based is reassessed as at 1 July 2027 and gains are only treated under the new regime beyond that?
So I think that was kind of same sort of question that we had before, in the sense that you've got this period up to 1st July 2027, gains prior to that, you need to effectively find out a valuation at that date under those two methods that we sort of mentioned. And any gains pre that time are eligible for the 50%, assuming tax resident. And after that, gains after that would be as on the indexation method. Now, as a non-resident, it's likely that none of the 50% or some of it might be applicable for resident periods. So that's how that one applies.
Yep. Um, I'll jump back to just one that was submitted. So, how do I prove my property would genuinely add to housing supply for ATO purposes? Was there anything in the budget papers surrounding this?
So, look, I've got to go through this in a bit more detail, but our expectation is that it's got to increase the number of dwellings.
Yep.
So, um, so they do mention like a block of land. There's no dwelling on that, and by building on that, you're creating a dwelling. So that is okay. So even though it's one for one, but you demolishing a dwelling, you're taking one away and then building another one to replace it, then you've got a net change of zero. So that, in my expectation, is not going to qualify. Whereas if you had one, you knocked it down, subdivided, put two on it, then you're going to be included as increasing supply. So that's how I expect them to assess that. But again, we need to wait and see how they actually define that, because
Yep.
maybe there's some sleepers in there.
Yeah, yeah, absolutely. Another one from Anonymous. I'm not sure if we can answer this one, but we'll give it a shot. Is it possible to create an overseas trust for inheritance purposes before returning to Australia, given it's less attractive to do so now in Australia? Beneficiaries will not be me, but for non-Australian tax residents. Mm,
Look, it's complicated. We need to see
yeah.
the residency of everyone. But if we're talking foreign um, foreign assets that are all going to non-residents, then it's likely they're going to be full out of Australian tax net anyway.
Hmm.
But you need to see, is there any Australian-based assets in
Yep.
there? Is there, who are the parties? Are there any Australian tax residents in that mix? Very hard to answer without knowing the specifics, but I wouldn't, there's nothing I'm thinking that comes up to mind as a silver bullet there.
Yep. Yep. It's good. Question here from David. Hi, can you please explain how the tax credit on discretionary trust works for individuals? Example, at a $50,000 income from the trust to an individual that is their only income. Do they get the
Mhm.
refund?
Yeah, so effectively, I'll just run some numbers here. So an individual on 50,000 and that's your only income,
Hmm.
if you were to receive it under the current rules, then that 50,000 is not taxed in the trust. It goes straight to your personal tax return. You're assuming that you're Australian tax resident. Your total tax that you pay on that at that rate is $6,538. Okay, so that is the tax um, that you would have in your tax return, and you need to come up with that. Now,
Yep.
if you go under this new regime, what would happen is the trust pays 30%
Mm,
at the trust level. So 50,000, uh, 30% is 15,000.
mm,
And when you then feed that income through to your personal tax return, you have lost any difference. So you get a full credit, so you wouldn't pay any personal tax, but effectively the total tax paid by the trust and yourself is 15,000, and effectively you're about $9,000 worse off. Um, as a non-resident, it may be different because your tax rate starts at 30%. So that may not be too bad, especially if
mm.
there's withholding tax or sort of those sorts of components involved, and they may be outside of this. But in a lot of cases, this is really going to be a significant downside to trust.
Yep. Yep. I agree. Question here from Chelsea. Negative gearing question. Subdivision projects take some time and often include purchasing an existing home on a large parcel of land with new titles not established for 1 or 2 years after the existing plot is acquired. Curious if the existing plot with subdivision potential and intention to develop declared would have negative gearing applied or only the new titles. Yeah.
Mm. So, I mean, negative gearing, if you've already owned the asset, negative gearing should continue to apply on this particular
Yep.
property, right?
Yep.
So regardless of that, the CGT discount aspect is another part you need to kind of work through. It does sound like though you are increasing the supply um, on those new titles, so I expect them to be able to be eligible for the 50% discount, although it sounds like the existing property may not be. that makes
Yep.
sense.
Yep. Yeah, it does. Yeah. Again, a lot of what we're discussing, we really need to see the draft legislation. The devil is definitely going to be in the details, and
Mhm.
most of these, even off the fact sheet, the cheat sheet that the government released, we're talking about sentences and small paragraphs where like there's a lot that's being talked about, but it is just commentary, some opinions as well, until we get the draft. Good morning, Peter. Another question here from Peter. Did the budget papers make any reference to any changes to how franking credits flow through trust structures and onto personal returns?
Mm. It it hasn't, from what I can see.
Hmm.
My expectation is that you will get so that it's talking about minimum 30% tax in the trust. So they're assessing that the trust. My expectation is that if you've got a 30% credit from a franked dividend, the trust won't pay any additional tax on that. Um, and that means, so if it's a 25% franked dividend based on an active business or something, there's probably 5% extra tax that the
Hmm.
trust needs to pay before they can pass that down. But it shouldn't be tax on tax within the trust structure itself. But when you're distributing that out to, say, a company, a bucket company structure, that's when you will get this position where that tax credit is lost through that arrangement. But yeah, there's a lot of question marks as to the mechanics of that I really am keen to see in the draft legislation.
Yeah, yeah, absolutely. Uh, in its current form, based on what we've seen from the budget measures and the papers, it renders bucket companies almost useless, to be honest, because you're double taxed. So really need to see that franking credits, if it's the minimum tax, need to know because it's not in the current budget papers, whether you're still getting the credit on the individual level and whether that's a refundable credit as well. So more to come. Question here from Anne. I inherited a pre-1985 property in 2018. It has been rented since then. If I move back to Australia and live in it, will I still get the main residence exemption?
So for you to get the main residence exemption, in addition to you being an Australian tax resident, then you need to have moved in and treated it as your main residence. So that is based on a few different factors, but it needs to effectively be your home. It
Yep,
sounds like in this situation, you inherited it whilst perhaps overseas and maybe never moved into it. You rented it
yep,
out. So
yep.
my expectation is that there's no periods of that property where it's been treated as your main residence.
Mm,
So my expectation based on the facts presented is that no, you wouldn't be eligible for the main residence exemption, but I could be mistaken there. If you want us to run through that with you, we're happy to do that, but we need to know
yep.
the specifics of it.
Yeah.
As
No.
far as, the second part of that question, which was when the best time to sell would be, very much dependent upon the growth of the property, your circumstances, your tax rates. Um, we often do modeling for people on these sorts of things based on assumptions that we agree, and then take a look at it and see if there's an obvious answer there for you.
Yep. Absolutely. Um, there was another question that was submitted before the budget. It was around, it's again around trust minimum tax, but how does the trust minimum tax interact with non-resident withholding tax on distributions?
Mhm. So my expectation is that the non-resident withholding tax items are kind of carved out separately from that component. Now, bear in mind that this 30% minimum tax and these rules are applying to discretionary trusts, not fixed trusts. So if you've got sort of a fixed trust units, then that's not going to be considered. Um, but we're talking about the remainder of the income, not the income subject to withholding tax that's being picked up. That should be somewhat preserved and treated as it is.
Yep. Yep. Yeah, absolutely. It's certainly a budget that's caused a lot of divide, probably younger generations versus the old generations when it comes to the property, the CGT, the negative gearing aspects. It's really going to be interesting just to see the legs it has and how quickly this moves through Parliament. Often when we get this kind of type of tax reform, Again, the draft legislation is released. It's very briefly consulted on, and consultation can often come from the major accounting bodies in Australia, as well as any major associations as well. Good one would be the FAR. Another one would be CPA, chartered accountants as well. But then if no structural changes or redesign, it moves into the House of Representatives, is voted on, and then it keeps moving all the way through. So we know we probably won't see any trust legislation until they probably maybe redesign it, carve out sort of testamentary trust perhaps, but we'll have to wait and see. I'll just wait a couple more moments just to see if there's any other questions. There was a lot of questions that were also asked last night, which we've sort of re-answered on today's session as well. Ben, is there anything that you think hasn't been probably asked or answered that we can address? I feel like we've probably covered both across the both sessions, but everyone obviously appears to be drilling down on the negative gearing, the CGT, some on trust, but I feel like that's where the main responsibility is going to lie on the draft legislation.
No, I can't think of anything specific that we'd want to raise in addition to what's been asked. That's
Yep.
kind of the key things that most people are asking.
Mm,
So yeah, look, obviously, just to reiterate the point, there's a lot of question marks still around some of these things, and we need to see some legislation, and that's really when we're going to be critically analysing the specifics of that and looking to communicate with people. But if you do have specific questions that you're looking to ask, please reach out to one of us, and we can put you on the right path with what we understand the position to be to date.
absolutely. Absolutely. Want to appreciate everyone tuning in for today. A pretty quick session because the budget is often designed for Australian tax residents. We've tried our best just to focus and narrow in and hone in on what would be relevant for Australian expats living overseas. Keep an eye on the socials as more comes out from the draft legislation. We'll be doing more sessions online. We'll be posting a lot of blogs. If you're not in our Facebook group, that's where we also share a lot of information. It's usually the first one to sort of get some of that information as well as our client listing on our mailing list. So keep an eye on that. If anything arises, any questions, please feel free to reach out. But really appreciate everyone tuning in today. We look forward to bringing you more updates as they arise and as we receive that draft legislation. Thanks for everyone tuning in. And Ben, as always, thanks for your time.
Pleasure. Thanks, everybody.